It's funny when you think about it, the stock market, it's this thing that like affects everybody. It's tied to like global events like wars and, peace and all this stuff. And then everybody's like 401k or, whatever retirement plan is tied up in it in some way.
Yeah.
But it just seems so like mysterious. Just a bunch of numbers flashing on screens.
Right. It feels very much like this.
Like a secret language, right? That like only certain people are in the know.
Yeah, I think you've hit on like a really key point there. The stock market often does feel incredibly complex and even impenetrable. But like when you actually break it down, the fundamentals of how it works are much more accessible than people think.
Yeah.
And that's really what we're going to be doing in this deep dive today, peeling back the layers, trying to understand how the stock market actually functions.
Right, exactly. And we've gone through, a lot of sources, a lot of material explaining the stuff, like all the nuts and bolts. And our goal is to really like extract the most important pieces, the key insights, the moments.
Yeah.
And present them to you in a way that cuts through all the jargon and really just like demystifies the whole process. So by the end, you should have a good understanding of like this vital part of the global economy.
Yeah.
And how like you as an individual can participate.
Exactly.
So where do we even begin with something like this? I guess the first thing is like, what even is the stock market?
Right. Well, think of it this way. Instead of like a farmer's market,
Okay.
where, you've got all your fruits and vegetables, imagine a giant marketplace, but instead of selling, produce, it's trading securities.
Interesting.
Things like stocks, bonds, commodities, even these complex things called derivatives.
So like stocks, I kind of get that. Like you're buying ownership of a company.
Exactly.
Like bonds, commodities, derivatives. What are those?
Yeah, so bonds are essentially like loans that you give to a company or a government, and in return, they pay you interest. Commodities, think of things like oil, gold, wheat, the raw materials. And derivatives, those are a little bit more complex. They're basically contracts that derive their value from an underlying asset like a stock or a commodity.
Okay, that's starting to make sense. So we've got this giant marketplace where all this buying and selling is happening
Yeah.
of these different, financial instruments. But like, why? Why does this marketplace even exist in the first place?
Yeah, that's the million-dollar question, right?
Yeah.
At its core, the stock market exists to help companies raise money, to raise capital. Instead of, just going to a bank and taking out a loan, companies can actually offer shares of ownership, what we call stocks, to the public. And when people buy those shares, those investors are basically giving the company money. Money that the company can use to grow, to expand, to do research and development, even just to keep their day-to-day operations running. And in return, those investors become, as you said, part owners of the company.
Right. So it's not just companies like getting free money. Investors are getting something out of this too.
Exactly. The stock market gives individuals, institutions, even pension funds the chance to invest in companies and potentially benefit from their success. So if a company performs well, the value of its stock, the price of those shares, tends to go up. And sometimes companies also pay out a portion of their profits to their shareholders in the form of dividends. It's like a reward for being an owner.
Oh, okay. So there's a potential upside for the investor.
Right. And on top of that, the stock market helps to ensure that prices are transparent.
Transparent. How so?
Well, because you have so many buyers and sellers constantly interacting, all trying to either buy low or sell high,
Yeah.
it creates this dynamic where the price of a stock at any given moment theoretically reflects its true value based on supply and demand. If lots of people want to buy a stock and not many people want to sell, the price goes up, and vice versa.
Oh, I see. So it's like a constantly adjusting, equilibrium.
Exactly.
Okay, that makes sense. So we've been talking a lot about stocks, but I think it's worth diving a little deeper into like what they actually are and how the whole trading process swims.
Right. So at the most basic level, a stock is a little piece of ownership in a company. When you buy a share of stock, you're buying a tiny slice of that business.
Okay.
Now, the first time a company offers its shares to the public, that's called an initial public offering or an IPO. And that's how the company raises its initial capital. They work with these investment banks, kind of like middlemen, to set an initial share price and sell those shares to both institutional investors, like big funds, and individual investors like you and me.
Okay, so that's the IPO, the big debut.
Yeah.
But what about all the buying and selling that happens afterwards, like the day-to-day trading we always hear about?
Right, that happens in what's called the secondary market. And this is where investors are trading shares with each other, not directly with the company. So if you buy a share of, let's say, Nestlé, you're not buying it from Nestlé directly. You're buying it from another investor who's decided to sell their shares.
Oh, so it's like a used car market almost.
In a way, yeah, the price you pay is determined by the current supply and demand for those shares at that very moment.
Okay, makes sense. Now, who are all these people buying and selling? I mean, obviously there are individuals, like you said,
Right.
but there must be other players in this game too, right?
Oh, absolutely. It's not just individuals, what we call retail investors. You've got these big institutions like banks, mutual funds, pension funds, hedge funds. They're all in the mix,
Right.
and they're often trading huge volumes of stock, which can really move the market. Then you've got brokers. Those are the platforms that allow us, both individuals and institutions, to actually access the market and place our buy and sell orders. Think of companies like eToro, Charles Schwab, Interactive Brokers, and so on.
Right, they're like the gatekeepers.
Exactly. And then to keep things running smoothly, you've got market makers. Their job is to ensure that there's always a buyer when someone wants to sell and a seller when someone wants to buy.
Oh, that's interesting. So they're like guaranteeing liquidity, making sure the market doesn't freeze up.
Right. They're always ready to buy or sell at a specific price, which keeps things moving. And of course, overseeing all of this, we have the regulators.
Right, someone has to make sure everyone's playing fair.
Exactly. Their job is to prevent fraud and manipulation, protect investors, and make sure the market operates transparently. In the U.S., that's the SEC, the Securities and Exchange Commission. Other countries have their own regulatory bodies, like FINMA in Switzerland.
Okay, so we've got all these players, this massive marketplace.
Right.
But like we said before, the big question is, how are those stock prices actually determined?
At the most fundamental level, it comes down to supply and demand. But what drives that supply and demand is a whole bunch of different factors. Obviously, a big one is the performance of the company itself. How profitable are they? Are they growing? Do they have good leadership? All of that influences how investors view the company, and that affects the demand for their stock.
Right. If a company's doing well, more people want to buy their stock. Makes sense.
Exactly. But it's not just about the company itself. The overall economic climate plays a huge role, too. Things like interest rates, inflation, unemployment, even like global events like wars or political instability, all of that can make the market more or less attractive to investors.
Right, because if the economy is tanking, why would anyone invest in the stock market?
Exactly. And then you have to factor in human psychology. People aren't always rational, especially when it comes to money. Fear, greed, rumors, hype, all of that can drive stock prices up or down, sometimes even irrationally.
Oh, yeah, definitely. Like, remember that whole GameStop thing a few years back?
Exactly. That was a classic example of how public sentiment, even if it's driven by social media, can have a real impact on the stock market.
Okay, so we've got this constant interplay of company performance, economic conditions, and investor psychology.
Right.
And that leads to the volatility we see, the constant ups and downs in the market. Why are stock prices always fluctuating?
It all boils down to information. New information is constantly coming out. Companies announce their earnings, new products, economic data gets released, global events unfold, and every bit of news gives investors a reason to reassess their expectations. So let's say a company announces amazing earnings.
Right.
Investors might get excited, think the company's going to continue doing well, and buy more of the stock, pushing the price up.
But what if the news is bad?
Then the opposite happens. Investors might get scared, think the company's in trouble, and start selling their shares, causing the price to drop. And these reactions can happen incredibly quickly. Like imagine a big tech company announces record profits. Their stock price could soar within minutes. But then, let's say news breaks that a key supplier for that company has gone bankrupt. Or there's a major scandal. Boom. That stock price could plummet just as fast.
So it's like a roller coaster ride.
Pretty much. And sometimes those drops can be really severe. That's when you get what's called a market crash.
Oh, yeah, crashes. Everyone's scared of those.
For good reason. A market crash is a sudden, sharp drop in stock prices across a large portion of the market. It often happens when there's widespread panic, when asset prices have gotten way too high compared to their actual value, what's called a bubble,
Right.
or because of some major unforeseen event like a global pandemic. And history is full of these crashes. The one in 1929 that led to the Great Depression is probably the most famous.
Yeah, I've heard about that.
But there have been others. The dot-com bubble burst in the early 2000s, the 2008 financial crisis, the COVID-19 crash in 2020. These things happen, and they can be really scary.
Right. But I've also heard that crashes can create opportunities. Is that true?
Yes, actually. While crashes are definitely painful in the short term, they can also present great buying opportunities for investors who are patient and have a long-term outlook. Because when prices drop sharply, it means you can buy shares in good companies at a much lower price. And then, as the market recovers, those investments can potentially generate big returns. It's all about seeing the potential in the midst of chaos.
That's an interesting perspective. So, given all this complexity, all these factors influencing the market, is there any way to predict what's going to happen? Can you tell when the market's going to go up or down?
That's the holy grail, isn't it? Everyone wants to know that.
Yeah.
But unfortunately, the reality is predicting short-term market movements is incredibly difficult, if not impossible. There are just too many variables at play, and human behavior is notoriously unpredictable. So trying to time the market perfectly is almost always a losing game.
Okay, but what about long-term trends? Can we make any educated guesses about where the market's headed over a longer period?
Over the long term, things become a bit more predictable. The research suggests that if you invest consistently, diversify your portfolio, and stay informed about the overall economic landscape, you can increase your chances of success. It's all about focusing on the long game, riding out the ups and downs, and not getting caught up in the short-term noise.
Right. Slow and steady wins the race.
Pretty much. Now, before we wrap up, I want to touch on something important. Even if you're not planning to actively trade stocks or invest a ton of money right now, understanding how the stock market works is still incredibly valuable.
Why is that?
Because the stock market isn't some isolated entity. It's a reflection of the real world, of how businesses are doing, of the overall health of the economy. It's like a giant thermometer measuring the temperature of the global financial system. So even if you're not directly involved, understanding how it works gives you a much better grasp of what's happening in the world around you.
Oh, I see. So it's like having a decoder ring for understanding the news.
Exactly. And for individuals, regardless of their investment goals, the key takeaway is that while the stock market can seem daunting, it's based on principles that are logical and understandable. Learning those principles can empower you to make smarter financial decisions and navigate the financial world with more confidence.
Right. Knowledge is power.
Exactly. And it's not just about personal finances. Understanding the stock market can help you make sense of broader economic trends, which can inform all sorts of decisions, not just investment decisions.
Okay, so this has been a really interesting deep dive into the stock market. I feel like I've learned a lot.
Me too, honestly. It's always good to revisit the fundamentals. And hopefully we've managed to demystify some of the complexities and make this whole thing a little less intimidating for our listeners.
Yeah, I think we've done a good job of breaking it down.
And the key message to remember is that even though there's a lot of jargon and the market can seem chaotic at times, the underlying principles are actually pretty straightforward. Anyone can understand it if they put in a little effort.
Exactly. And on that note, I'll leave you with a final thought to ponder. Think about how the constant flow of information, everything from new technologies to global events to social media trends, is constantly shaping our perceptions of different companies and industries, and how those perceptions, those collective beliefs, ultimately translate into the perceived value of those companies.
Yeah, that's fascinating.
The stock market is like a window into that process, into how we collectively assign value to the things that shape our world. It's a constantly evolving, fascinating system, and understanding it can give you a real edge in navigating the complexities of modern life.
I couldn't have said it better myself.
Well, thanks for joining me for this deep dive. I hope you all found it as enlightening as I did. Until next time.
Thanks for having me. It was a pleasure.